The tax treatment of stock options depends entirely on which one you have, when you exercise them, and when you sell them. So if you have incentive stock options, again, ISOs, they can receive more favorable tax treatment than non-qualified stock options, but you need to follow the rules. When either type of options are granted, there's no tax. When ISOs vest, there's still no tax. If you are able to exercise ISOs, there's no federal income tax implications, but there is for the alternative minimum tax. So for the AMT tax calculation, the spread between your strike price and the stock's current value, or the 409A, is includable under that parallel tax system, the AMT, and you pay the higher of the two. So this can really create problems for people because they could owe tax when they have it sold or they can't sell. So you really don't want to ever trigger the AMT unless you're planning for it. When you sell incentive stock options, you can have more favorable tax treatment if you meet the holding periods. So you want to have a qualifying disposition if possible. And that means that you've waited at least 2 years since the original grant date and 1 year after you've exercised your options. Again, you have to meet both requirements. If you do, you only pay long-term capital gains tax on the whole thing. That rate goes between 0%, yes, 0%, 15% and 20% at the federal level. And of course, there could be state tax implications too. But it's significantly better than ordinary income. But if you don't have a qualifying disposition, it's called a disqualifying disposition. And in that case, the spread at exercise will be taxed as ordinary income, but it won't be subject to payroll tax. And any additional gain between the price when you exercise the stock and the sale will be taxed as either a short or a long-term capital gain, depending on if you held it for more than a year after you exercised. So if you exercised and sold immediately, let's say in a cashless exercise, you would only owe ordinary income tax on the spread with no capital gain to report. Non-qualified stock options, or NSOs, are taxed a bit less favorably than ISOs, but they're more straightforward. So again, just like with ISOs, there's no tax at grant or vesting. But the moment that you exercise non-qualified stock options, it is taxable income in the regular tax system. The spread between your strike price and the fair market value of the stock at exercise, or 409A, is taxed as ordinary income, just like your salary. Federal tax withholding will apply. It's typically 22% if that spread is under $1 million. If it's greater than $1 million, it's 37%. Employers do need to do payroll tax withholding for this as well, and they might allow you to elect additional withholding, but the very minimum, it's these statutory tax rates. When you sell the shares, any additional gain above your cost basis, and your cost basis essentially just becomes the fair market value of the stock when you had exercised, is taxed as a capital gain. It'll be a long or short-term capital gain depending on how long you held the stock for. But this is why it's much harder to exercise non-qualified stock options at private companies or startups, because when there is a spread, it can just be really cash intensive for people. So in another video, we'll cover strategies for managing and optimizing taxes with your stock options.